RBC Capital, this is like banks too. Capital Markets, in a note to institutional clients, is forecasting mortgage defaults won't rise until the second half of 2021. So in the second half of 2021, that can getting further kicked down the road, we can expect, according to the banks, to see some defaults happening. Good morning, investors. Bradley here from Watson Estates. You're listening to the largest, fast-growing podcast for Toronto real estate on iTunes, Spotify, and Google Podcast. Thanks for joining us on an ongoing basis as we keep up to date with what's going on in our local market. Now, if this year wasn't scary enough, tomorrow's Halloween, and as we round into this fabulous weekend, I want to share with you guys some of the big news that's happened in and around our market. I, as an investor and as a broker, want to know for myself and for my clients where are there going to be opportunities in our marketplace and really stay up to date. And really, I am obsessed with the market, if you can't already tell. And so I'm so thrilled that you guys have been able to join us on a journey. I've had some great conversations with some of you online and in person, and it's been a wonderful adventure. So what are we going to talk about today? There has been a ton of news. You're going to learn a whole bunch of stuff, and we're going to have some fun. So number one, what do Canada's big six banks expect real estate prices to do? I think you're going to be surprised to see what the banks are expecting to see at the end of 2020 into next year. We're going to talk a little bit about that and the feud that has emerged over the last few months. And what are the top Canadian real estate trends in 2021? Very much could have been a first article. This comes from a PwC Canada and Urban Land Institute report talking about what they expect will be the major trends as we round into 2021. And again, another fabulous topic. We are loaded. Even the hot topics are loaded with goodies today. Trick or treat. What role will immigration play in the housing market? Before we kind of get warmed up here, we like to have some fun. I like to practice my humor, which many people like to laugh at me, which is equally entertaining for you. So win-win. Now, the question here is, before I go there, I just want to tell you guys yesterday, we had a lot of fun. We were carving pumpkins, and it was Emily's very first pumpkin, which was kind of cool. My older daughter, she's turning 3 later this year, and it was beautiful, or it was gorgeous. But before we go there, gotta have some serious news. Wrap this up here. This is not really, we're not in Halloween yet. Today I'm recording this. This is Hallows Eve, the day before Halloween, and so I just wanted to, now that I've got your attention, make a statement to those kids last year who TP'd my property. The joke's on you now. Bring it on, baby. But anyways, we have some fun. We're going to jump into the real estate market, but let's have a little bit of a healthy competition here and trying to grow the channel very much organically. I haven't really pushed or advertised this channel a whole lot. If you guys could, if you're following us on YouTube, please hit that like button down below. And you're following us on our podcast channel, if you guys could download the last 5 episodes of our channel, it really helps. And I know you guys are supportive. You guys have become an amazing family of listeners. And I'm so glad that we could do this today. I hope you guys are ready. Here we go. So we're going to start off talking about the banks. Okay. This article is called, and another fun fact, chill, daddy, chill. Okay. I've been receiving a lot of questions from some of you guys asking, hey, Brad, where do you get these sources from? Can you share with us the links? Because I'm not smart enough to make all this information up, and so I want to be able to share with you. I'm going to try that out today. Let me know what you think in the comments if it's helpful. But the first article is called, and it's down below, Cracks in Real Estate Market Fail to Rattle Canada's Big Banks. Here's what they got to say. Parts of Canada's housing market are showing strain, but one group isn't buying into dire warnings about the end of a decade-long boom. The bankers writing most of the mortgages. So here they're saying the banks themselves are not as freaked out as you guys are. A number of forecasters, including Moody's, UBS Group, AG, and the country's top housing regulator, are predicting a sharp correction over the next year. Canada's largest banks aren't worried, though. On average, the 6 lenders see price declines of about 3% over the next 12 months. Not the 21% we're going to hear about in just a second. In fact, Bank of Montreal sees no change at all to the average house prices. Okay, so what are the bears saying? Let's come up with this big feud here. Let's position this. What are the bears saying? They say contrast that the federal government's CMHC, which is calling for a 21% plunge in prices. And if you've been following this, you're like, what do you mean 21%? They've said 9 to 18%. Bradley, you're misquoting that amount. I'm reading it right here. And why do we say that? Because they didn't give specifics as to where that decline would happen. Right. And one of the big differences, and we'll talk about that in a second, one of the big differences that happen here is this, they call a disparity can be traced back to the data the various groups are working from. Here's the difference of opinion. And depending on what your beginning evidence is or what you're using as your assumptions, you will figure out what your thinking prices will do. Here's what they say. UBS and some other forecasters are working from a high level economic and demographic figure that suggests prices currently are out of line with the trends in income, employment, and immigration. So we are starting from a bad situation. That is the assumption that they are making, right? Now, banks have developed market views. They say it's through things like the number and the size of mortgage pre-approvals working through the system, the flow of money through customers' checking account. The trajectory of housing prices over the next 12 months will be critical to Canada's banks' earnings. They say this, a strong property market has provided a reliable earning stream for banks for decades. Oh, so they're biased. And you're pretending like you're not. Yes, the banks are also biased. In fact, residential mortgages make up 40% of their loans on average for the big six banks. And the amount adds up over these mortgages of 1.13 trillion in residential mortgages on the books at the end of July. So it matters to them that the prices don't crash. Is that the reason they're giving that prediction? Maybe that's why they've got the assumptions that they have. But housing bulls, to put this into big perspective, contend that the numbers make sense. Virus-related declines in the immigration and jobs will soon reverse. They argue, and as long as COVID-19 is with us, homes become more valuable as primary locations for people's work, education, and recreation. So the same reason that people are freaked out that the housing market is doing bad is the reason that they think it's doing good, because they think all of our investments are going to go into this one category. This is the safe haven for most people, but that's not what bears think. That's not what bears think. Bears say that the economic fallout from the pandemic will keep unemployment high for a long time and slow the flow of immigrants that has helped boost demand for homes. That's part of Moody's call for a 7% price decline. They say this is Moody's. The housing market will no longer be able to escape the poor condition of the labor market as vacancy and delinquency rates rise in 2021. Even some of the banks are talking about this delinquency potential. Toronto, Canada's largest housing market, was number 3 on UBS's real estate bubble index. You guys will remember that came out last month, and we talked about it. But that's also, bulls would point to the fact that that's also the reason why we're able to rebound so quickly. But in direct opposition to that bubble idea, you guys will remember from our last podcast, if you look as a whole, GDPs around the world are down, yet prices on average by a large margin are up. So it's not just Toronto. So there's more to this story. But I want to dive into the CMHC prediction before we move on. They say one of the biggest bears we know is the CMHC. And they say given the average price of a house in August was $586,000, prices would need to plunge 21% by the end of next March to line up with their forecast that they gave in the first quarter. So yes, they had originally said 9 to 18%, but because they've reaffirmed that commitment to the 9 to 18%, what they're saying, because prices have gone up in August, and I love when people highlight this because we've been talking about it on our podcast, but it's so true. Prices are no longer at $460,000 average. Now they're at $586,000 average. So what you're saying is an over 20% plunge in prices. In order to make that work, the main thing here is the dates matter. Dates matter. To all my single friends, fun fact. Speaking of dates, Halloween falls on a Friday the 13th this year. Don't believe me? Look it up. So while CMHC's chief economist Bob Dugan officially reiterated the forecast last month, the organization has since suggested, you lose. They have since suggested there may be room to soften its view. You know what? We might be a little bit overstating. We don't know, but maybe. But bringing it back down to the banks and to wrap up this particular article, what is the worst case scenario? What is the bottom line? Well, 20% drop in housing prices would hurt the bank's earnings. Absolutely. We just talked about what that looks like. It would be unlikely to damage, though, their balance sheet unless it was accompanied by, they say, a sharp increase in unemployment that hurt the ability of borrowers to pay their mortgages. Yeah, and is CERB not a thing? So we know Bank of Canada has been standing behind us to this point, and that's assuming they wouldn't even step in there. So all of the stars need to be well aligned for things to fall apart, according to the banks. Even then, they say the banks are adequately provisioned for potential loan losses, and many of their mortgages are insured by CMHC or other insurance providers, he stressed. In most provinces, lenders are also able to claim on the other financial assets of the borrower should they default. We're talking investment portfolios, checking accounts, and the like. The banks are good. The banks are fine. And they're confident in our market. Whatever your views are on that, I mean, depending on the article, because I can jump into a better dwelling article, which I'll do for you right here, and forget everything I said so far. Just listen to this article and tell me this doesn't kind of counter everything that last one stood for. RBC forecasts Canadian mortgage defaults will rise starting next year. RBC Capital, this is like banks too. Capital Markets, in a note to institutional clients, is forecasting mortgage defaults won't rise until the second half of 2021. So in the second half of 2021, that can getting further kicked down the road, we can expect, according to the banks, to see some defaults happening. We should see the defaults in 4 to 6 months? Question. The bank says, not exactly. RBC thinks enhanced EIN programs like the Canada Recovery Benefit delayed the trend. Currently, those supports won't end until March and April, and we've seen a lot of business supports seem to be lining up with mid-year even. So that's your 6 months. And this has them estimating 4 to 6 months from then, Q3 to Q4 2021, before we have ourselves a bunch of delinquencies hitting the banks. But again, a whole other view. Now we're saying RBC is thinking there's going to be delinquencies in 2021. And a minute ago, we said there won't be any price correction. If there is, it's going to be quite moderate. Anyways, we've come a long way, I would say. Maybe you guys agree with COVID. But like the music mummies listen to, it's far from a rap. But we know it's not the good stuff. It's not the good rap. I mean, it's not like Eminem likes Halloween. There's too many ghostwriters. All right, so let's move on. Another amazing topic, this idea of the top trends in Canadian housing for 2021. This is a Toronto Stories article. Again, find it down the link below. Price Waterhouse Cooper Canada and the Urban Land Institute teamed up to share their take on what Canadian real estate trends will take precedence in 2021. And I want to give you guys the highlight. The report suggests the best opportunities going into 2021 include warehousing and fulfillment, multifamily residential, and medical office space. That's the highlights. But when it comes to residential, more specifically, they point to a couple things. One, they call this 18-hour cities, which are described as a mid-sized city with attractive amenities higher than the average population growth and a lower cost of living and cost of doing business with bigger urban areas. And this is kind of their pick. They say it's within a larger city, 18 hours of Toronto, Montreal, or places like Victoria, Quebec City, or Halifax because of all the accelerated growth. But then they've got this other kind of subcategory called 15-minute cities. Ottawa, for example, would be a 15-minute city within 15 minutes of their home, either by walking or cycling, being very close in some of these up-and-coming emerging markets. And I saw another Toronto Stories article talking about Mississauga. You can check that one out if you're interested in that market, but it's called this: From Downtown to Urban Center, Why Mississauga Could Be the Move to Make. And you could fill Mississauga in with any neighboring city. These stats are tried and true for all of them. Mississauga real estate is on a tear, reflecting the considerable efforts the city has made in its livability factor, transforming it from a commuter suburb to an urban center within the stress of the downtown Toronto living. All of these outskirt communities are doing absolutely incredible. They're very, very successful. And so any article that talks about the 416 versus the 905 is always saying, in every case, it would seem, I can't think of a scenario it doesn't, the 905 is outperforming the 416. And that's what we see here as well. Now, in the commercial space, just to kind of highlight the rest of this article, fulfillment centers, warehouses are going to continue to have this huge demand, whereas office spaces are very uncertain. There's a return to office process that people are uncertain of whether that's going to happen. They say 34% of employees said in this report, a future survey from September 2020, that 34% would work mostly or entirely remotely. 37% said they would work from the office most or all of the time, with the remaining 29% looking for an even split between the two options. So it's very torn down the middle on whether people would prefer to go back to work or work from home. It seems to be almost 50-50 at this point. And I saw a Twitter post from Zealand, and he asked a question: with a recent surge in COVID cases in Canada, how would you describe your behavior? The largest answer, by the way, was cautious, less than April. And that was 53% of people. So people are being cautious, but less than April. People are opening up a little bit. In fact, only 18% are saying that they're more cautious than back in April, and the rest seem to be less or not at all. All right, medical office. I thought this is an interesting point. They're saying this idea that you're going to need a lot of more healthcare options, and maybe they can move into places like malls or high traffic community locations, an interesting trend, and that property technology, as anything right now, is going to become instrumental. Industry digitization has accelerated, as they say. And I just wanted to talk as well, as we're kind of wrapping all of these things in a pretty little bow. We're gift wrapping them pre-Christmas. Don't have your Christmas stuff out now. Still got Remembrance Day coming. But I saw another Zealand post, September GTA, new construction data for any of you guys considering projects, upcoming projects, or just curious what's happening in that world. Here are some of the highlights they point out. Overall, year-to-date sales are in line with the 10-year average. New condo benchmark prices exceeded $1 million. So condo prices on the pre-construction side are growing. Whereas, however, detached to condo price gap continues to widen. So yes, condos are going up. However, the detached, the low-rise stuff is still way outpacing the condos, and record low-rise sales in at least 5 years. We're hitting new numbers in the low-rise segment, and yet people continue to run for the suburbs. And one of the things that's tricking the entire stats of the average sale price is this idea of being over $2 million. There was an amazing thing here that kind of maps out the share of $2 million or more purchase price in the GTA. Now, back in 2016, I'll give you some of the highlights here. In 2016, over $2 million made up 3.3% of all the sales in 2020 dollars. In 2017, it jumped up to 4.3. After that, 2018, everything came back down, 2.9, 2019, 2.7. It's been floating well. 2020 is skyrocketing again in these high ticket items, these high ticket product over $2 million. It's now at 3.7%. It'll be interesting to see if this trend continues, but absolutely have no fear. Average price is being skewed by some of the high ticket products over the $2 million. But we need to be careful. When we become dependent on the heavy hitters to carry our market, things can come down pretty hard on the other side, as we saw in 2018. Like, did you hear about that pumpkin, the 200-pound pumpkin that fell on a local man's head today? Woo! Reports say he was squashed. What goes up must come down. All right, let's do some hot topics. Unbelievable topics today, guys. When I really could have done a podcast yesterday, so you're getting a crash course. You've got one of those hydro, what do they call it? The water hydro things the firefighters use. Anyways, to spray, shooting in your face. I don't know why people ask me to public speak. I really don't. It's a fire hydrant where the water's shooting you in the face. Drink up, people. Here we go. All right. All right, reasons to stop worrying the pandemic will be followed by a plague of tax increases. We had an accountant, Leo, a good friend of mine back from university days, on our show to teach you guys a little bit about the primary residence exemption and the risk of a change to capital gains. If you missed it, definitely go back and check it out. You're going to be finding that very, very interesting. But I like this article that comes from Globe and Mail because they question that whole thing. And they say these are some of the reasons taxes cannot and will not go up. Okay, I'm interested. I love counterpoints. The idea that we've spent a lot of money and therefore taxes need to go up is overly simplistic in a new complicated world with extraordinarily low interest rates for a long period of time. That's the warm-up. Miss Donald bases her argument that taxes aren't about to rise on the fact that the cost of carrying debt is more important right now than the amount of debt. I'm going to repeat that. The cost of carrying debt is more important right now than the amount of debt. That's a very interesting and valid point. Here are the 3 reasons they give why you're not going to see big impacts to your taxes, though the gross debt grows. Government holds the debt. Reason number 1, 80% of the Government of Canada bonds issued since March are held by the central bank. So the government is holding the bonds. This is significant because it means most of the borrowing by the feds in the pandemic is financed domestically and not by foreign investors who might balk at further buying without higher rates to entice them. So we got our finger on the trigger. And I've seen stats that say by next year, the Government of Canada will have more than 50% of the overall bonds. So that's a big factor. We have things held domestically. We're not threatened by the world. Reason number 2 is history. She says this: it took 8 years for global interest rates to rise following the 2008 recession. Sounds about right. It didn't last long, right? And this is a recession that is multiplied worse than that. So if it took them 8 full years just to get interest rates back up again, you think we're going to be increasing rates anytime soon? Forget 3 years, which we'll talk about in a second. And reason number 3 is we can't afford the increases. The weak economy itself is another reason to avoid tax increases. Can't afford it. Figure it out. Higher taxes leave individuals and businesses with less to spend. Hopefully, this article gives you a second perspective. You might have been freaking out for your investment portfolio. Oh my God, all these corporations, I'm going to get charged like crazy. They're going to increase all my taxes. How am I going to pay for all these people and their debt and their CERB? Oh my goodness, right? But don't worry. Don't worry. You're not going to get stung, if this article is correct, by a rise of taxes anytime soon. In fact, the only kind of bees coming for you this Halloween are the boobies. All right. Another fun fact, hot topic, is electricity. You might not know that the time of use billing is coming back as of the end of October 31st. So as of tomorrow, we're going to see things change back, and they're expecting it's going to increase the cost of pricing by 1.97%. Keep that in mind. However, there are other options available. They've come up with some tiered pricing system. If you want to look into that, you can. For residential customers, you can kind of play around. They're trying to give other options. But the point here is electricity rates are going to be going up in the next couple days. Another fun fact, hot topic, the Bank of Canada governor says digital dollar project moving past trial stage. Now, this comes from Coindesk.com, very pro-crypto, but I like this because in an interview with Reuters on Thursday, the Bank of Canada governor, Tiff McClellan, said his institution is working with G7 member states on its plan for central bank digital currency. They call it CBDC, digital currency. Not something that we're pushing right now, they say, but something we need to have available in case someone else does it. We want to make sure that we're ahead of the curve. The central bank wants to be ready if digital currency takes over. Crypto friends are out here and they're scaring them online, right? They're saying Bitcoin's the way of the future. We don't have any more control of us, right? Terabytes. Online is freaking them out with the terabytes. Okay. CBC.com, Bank of Canada, interest rates. Where are they going to go? What comes next? You probably heard this. If you did not hear interest rates are staying flat for 3 years, you haven't listened to our podcast for the last few months, and you missed the Bank of Canada announcement that came out just yesterday. They're saying they expect a vaccine by 2022. That's relieving because 2022 sounds pretty soon. Expect things to stay the same for the next 2 years at least. But they're not planning on changing the benchmark interest rate for the next 3 years. And that's no surprise. Whether you're in a fixed rate or a variable rate is almost irrelevant. It's almost dependent now strictly on the lenders and whether there's a risk premium that's going to be added. In the meantime, rates are just going to stay kind of where they are and nothing's going to happen. Bye, bye, bye. Bye, bye, bye. All right. Trudeau unveils a $1 billion rapid housing initiative. Toronto to receive $203 million. I thought this was worth pointing out here. This is pretty incredible. Toronto is the big breadwinner. We're getting a ton of money here from the Trudeau government. They've announced $1 billion, half of which is going to be going out very, very soon. And Toronto is the big old recipient of $203 million of that. What is it for? The RHI, known as the Rapid Housing Initiative, will quickly develop modular multi-unit residents, convert non-residential buildings into affordable multi-residential homes, and rehabilitate buildings that are abandoned. It's also going to be used for the land purchase to do these things. And we saw, there was an article a couple days back we talked about where there was a ton of mobile homes, modular homes rather, being put up immediately. And it's all part of this plan. Expect that to continue. Other cities in our area that are benefiting from this donation is London, Hamilton, region of Waterloo, and the region of Peel. Canada's biggest city, Toronto. We take the cake. Globalnews.ca, Canada ranks 3rd of 50 countries for top Nation brand. Oh my, what am I reading? The Nation brand. The national brand, the nation brand is the word I'm looking for, according to Ipsos. The 2020 Ann Holt Ipsos Nation Brands Index, the NBI, found that we are, for the second year in a row, 3rd, placed only behind Germany and the UK. Toronto is the greatest city in the world. I'm sorry. It is true. But really? People want to come to Canada? No. Which brings me to my last and final topic, this idea of immigration. The role of immigration in our society is huge. There are many, many international strangers who want to come here, and it's up to us to be welcoming. It really is. I'm sorry, as a Jehovah's Witness, we don't celebrate Halloween. Please move along. Guess they don't appreciate strangers knocking on their door. Who could blame them? So let's talk about immigration. Let's talk about these strangers knocking on our door. Are we going to welcome them or not? Well, we know in the last few years, absolutely. Last year, we had huge targets for immigration, huge targets. Well, what comes next? Well, the star is going to warm us up here. Immigration shortfalls from COVID-19 may spell short-term gain, but long-term pain for housing market. It's very, very, very important to note the difference between what happened in the short term through immigration and what that means for us in the long term. Canada's failure to meet its immigration targets due to the pandemic is offering some relief in terms of rent affordability, which is why rent's been spanked, by the way. Now, here's an important fact, though. It's not just immigration. I think we ignore this a lot. Rents are being spanked in a lot of major metropolitan areas. Get me a metropolitan. Cosmopolitan. Is that a drink or too girly for me? I don't know. Get me some booze. It's Halloween. That was pretty clever. All right. But at least in the near term, right? It's going to affect things in the way of the rental space. But how does that affect us in the long term? This article talks all about this. Ottawa prepares to announce its new immigration target in the coming days. If there's anything to look forward to from the time that I finish recording this podcast until I see you guys next time, it's this. Right? They are making an announcement today at noon. In fact, within 15 minutes of the time that I'm shooting this podcast, this will all be rolled out and there'll be an announcement made. You're going to know about it. And we want to watch and see what they say. We'll talk about what I think they're going to say, but we'll get there in a second. Immigration is good, in my opinion, and necessary for real estate. In fact, they say it here too. Sustaining robust immigration levels are vital for the Canadian economy and the long-term health of the real estate market. I mean, if you disagree with that, then I don't think you're a true investor. I don't know too many investors that would disagree with that. And one of the things that they're spotting is in the U.S. election. CEO Phil Soper, S-O-P-E-R, said his company statement comes as the website shows a spike in searches from other countries, particularly the U.S. Quote, I see a correlation between that and the fact that in the 2019 Royal LePage study, 75% of newcomers did not even consider the U.S. as an alternative when they came to Canada. It's not Canada versus the U.S. Let's make this clear, right? Let's make it clear. They're trying to make it great again. We are on another level. Only about 60% of the 341,000 immigrants it had targeted are expected to arrive in Canada this year. Of course, we got hit this year. They say only about 60%. Guys, to me, that number sounds high. Honestly, I would think it'd be less than 50%. If we can get 60%, that is a miracle and a half. It really is. Toronto is an incredible place for immigration on a whole other level. The largest, the fastest growing city in all of North America. Really is. Research showed that newcomers don't purchase a home until, though, they've been here for 3 years. And this is where the difference, the break between the short-term impact to real estate prices and the long-term. So in other words, the longer this endures, if it doesn't take until 2022 to get a vaccine and we don't have immigration until that point, we can have ourselves a real problem, real estate problem. CRA doesn't see low immigration impacting prices. So according to CREA, C-R-E-A, the CREA, Canadian Real Estate Association, they don't see it as an impact, but they're biased anyways. It's just National Real Estate Association. They say reduced demand from international immigration is certainly not holding the market back in any way. We'll see. We'll see. We got to get this sorted out, guys. The 4 highest years on record for net immigration from 2016 to 2019. That's the top. That was the top. So we're coming from a high. And that's working in our favor. It might blend in a bad 2020 if we can get our cards in order here. Not all immigration, though, is equal for housing. Another incredible point. Just because they come here, immigration in every case does not support a real estate market. Think of the non-permanent residents, right? Students, right? They're not looking to be home buyers. Their absence, however, impacts condos and multi-unit family rentals. And this is why this is spiraling into the rental community. It's a break from what we were experiencing, rent growth that was 2 or 3 times the rate of inflation and probably outstripping wage growth by a great big margin. And we've talked about how the decrease, I've seen this in past podcasts, we've discussed this, how the declines we've experienced in the rental market are a correction. It's a long-term correction because the scale by which we were growing in the last few years were unbelievably fast. Ridiculous. So all of the drops that would seem ridiculous, the double-digit drops across the GTA, is merely getting back to the long-term 10-year trend. But of course, condos are impacted. I saw a couple articles, one just to highlight them. Financial Post, listings skyrocket while leases are up and rents are down. There was another Globe and Mail, parking and price drop sweetens Toronto condo deal. People are trying to get rid of their condos, but the news doesn't stop there because as we're tracking the months of inventory for condominiums, there was a slight dip in the months of inventory, meaning it's a tighter scenario, meaning prices aren't dropping necessarily. Listen to this. Scott Ingram on Twitter says, months of inventory for 416 freehold has held consistently low at 1.7 over the past few weeks. With 416 condos having a dropping inventory now, it is within the past few years, it has been within 1.4 to 1.7 since July. But condos are seeing a slight uptick in the rolling 30-day of sales, and months of inventory dipped this week. So months of inventory has actually tightened. Is this a long-term thing or just a blip? We will see. But I think it's important to know the counterpoint to this. One of the things I want you guys to note, though, as we're like, oh my gosh, we got months of inventory coming back down. Sweet. Glad I didn't sell. Glad I listened to Brad 2 months ago. Okay, well, wait. Hold your horses. Here's the counterpoint, okay? There was an article from the Globe and Mail, and I think this is important to note. I see this all the time, but it's nice to see it in the articles because it reminds me to tell you guys. Relistings disguise Toronto chaotic condo market. Nearly half of new, quote unquote, new listings for condo apartments and condo townhomes in the 416 area last month were actually relistings of the same property. They were repeat listings. Half. The number of listings canceled each month has been climbing since April. Man, so the practice, just so you know, so let me kind of explain this to you. If you got your house on the market for 3-4 weeks in a market like Toronto, you should not, if your house is on the market for 3 weeks, you're doing something wrong, change your marketing, reprice it, whatever, but we need to freshen up that days on market. And that's what they do. They take it down, they relist it, and I do it too. It makes sense strategically, but it completely messes with our months of inventory figures. Because if we're saying we got 6 months of inventory as a seller's market, yet people, like half of the ones coming on are being relisted, that's messing up our numbers. These damn realtors, man, they're working to hide the real months of inventory in the days on market. They're like that time my wife and I, we dressed up like the Peruvian owls for Halloween. We were in cahoots. In cahoots. I went to Peru a few years ago, so I like that joke. I don't know if you do, but that's okay. Our immigrants have money. So last year, a Royal LePage study found that newcomers were expected to account for 1 in 5 home purchases in the next 5 years. Because a lot of people think, oh, they're coming, they're going to take our land. But no, that actually, it'd be more legitimate to be upset that they're inflating the prices of your real estate because they want it. Half of the immigrants surveyed purchased a detached home and 18% bought a condo. About 46% of immigrants to Canada came to Ontario. Almost half, where 29% became homeowners. So a third of the half became homeowners in our city or in our province. Newcomers were expected to purchase 286,000 homes within 5 years, according to the study. So COVID happened. Then what? I mean, I even saw an article from Better Dwelling saying over 7% of Toronto's new condo owned by non-residents. This is a 2019. They got little charts and stuff. You can check that out. But Canadians, they say, are increasingly open to welcoming immigrants and refugees, according to a study. This is a CBC.ca article. I'm not going to dive into it. You can check that out. There's not a whole lot of beef to it anyways. But people are more welcoming of immigration, and we need to be. And this is where there's going to be an announcement today, which you're going to want to check out by the end of the day. By the time you're hearing this podcast, maybe go on and check out what they say. My expectation is that we're going to get lots of immigration, as much as possible, as much as the government possibly can. Right? A large welcoming of immigration should make us happy, especially investors, people who are in the market. If you're not in the market, well, then I guess you can afford to be mad at them because they're going to push the prices up, right? But we should be happy. Us as investors should be happy, just as happy as a Catholic priest on Halloween. Free delivery. I don't know about you guys. I had some fun today. I hope you guys have a fabulous Halloween. Make sure you're not already, make sure you jump onto our investor list. Also, we're looking for joint venture partners as we continue to grow our portfolio. All the sweet deals and stuff, even before these investors are seeing. I want to be able to get a piece of this, and I want to work with you guys to get the best opportunities we can and to make some money together. Let's do it. As well, if you're following us on YouTube, please hit that like button. And if you're following us on podcast, please download the last 5 episodes. Again, I don't ask for this a lot. I might start asking for it more often because it really does matter. These engagements make a big difference. Halloween, though, to wrap it all up today, I like to wrap things up nice and with a nice little bow here and make you leave smiling or confused. But not being able to get dressed up for Halloween or to go get your hair did or whatever the girls would have done this Halloween is not really a big deal, right? Like, I mean, it doesn't have to be a bad thing. Like, think of it this way. Imagine being the barber, like Satan's barber, right? Last time, it's stressful. The last time he messed up, there was hell to pay. Anyways, I think that's funny. Anyways, I hope you guys had a wonderful time. Thank you for joining us again on Toronto's #1 real estate podcast, and I will catch you guys next time. Take care and keep it real.